Hello, everybody. Welcome to the Energy Newsbeat podcast. My name's Stu Turley, President and CEO of the Sandstone Group. We are absolutely, right now, we are recording this on a Monday, and this is absolutely, we're in a wait and see mode after the United States took out the three sites in Iran, and we are trying to figure out if Iran is going to retaliate. I wanted to find out what's going on in the commodities markets, and I rely on key people around the world that understand finance and financial markets. And my special guest has been on the podcast several times, and I truly respect him and his opinion and everything he's doing at Samaria Partners. Wasif Latif. How are you today, Wasif?
Doing great, Stu. How are you? Thanks for having me.
I'll tell you what, I have gotten such great feedback on all of your podcast and your visits and your insights. I rely heavily on folks that are actually, doing this for a living and understand things. And I want to hear what your thoughts are on what's going to happen in the commodities market in this really wild times we got going on right now.
Thanks for having me, and it's a great question. It's always a pleasure to join you and talk about this stuff. It's a passion of mine, and I've been following this stuff for years. Being a macro type of an allocation person and thinking about the world from the top down and looking at things. And the things as they're playing out are largely falling in line with the framework that we developed several years ago to think about the world. Of the big picture cycle of commodities generally being out of favor, and at some point becoming unloved, underinvested, underowned, and underappreciated.
Right.
And we've had all of that, and then the plague and I should say the plague, the pandemic came around, and the pandemic focused the world's attention on the underlying commodities that are needed for economic growth, economic prosperity. And then a few years after that, we saw an escalation of the geopolitical risks. And whenever you have a spike in geopolitics and a increasing stresses around the world when it comes to any kind of military activity or a resource activity, that generally means there's going to be a bid for commodities. There seems to be a correlation of that with history. And so what we're seeing now to us largely is falling in line with our worldview that we established a few years ago, that we entered since the pandemic a world where we're going to see heightened stresses in terms of geopolitics, heightened stresses in terms of budgets and fiscal deficits around the world, and as a realization of the world that energy is at the core of everything that we do. That's what we call energy is life. It's a phrase that a lot of folks, including our mutual friend Doomberg, uses a lot. It is something that is essential to economic and human prosperity. And so all of those things are playing out to us, and it falls in line with our sub-themes of our commodity supercycle that we think began in the sort of the dying periods of the pandemic. So by the end of 2021, early 2022, you had a resurgence of energy prices as the world got out of the lockdowns and began to consume again, travel again, work again, move again. And then the realization that the underinvestment had been there. And so now, on top of that, when you throw in the geopolitical escalation that has continued on very gradually, every year there's been something new that occurs that gets added on to the pre-existing geopolitical stresses and tensions and conflicts around the world. And so that just continues to move on top of that and add to it. So to us, this is an additional new escalation, if you will. Now, having said that, over a medium term or a short term basis, generally speaking, when you have a geopolitical flare up, the markets on the financial side generally tend to fade this because it's an immediate reaction and an immediate move. And history tells us that that flare up and that immediate spike in, for example, energy prices or volatility in the market generally fades over time because cooler heads prevail, or some kind of a stalemate emerges, or a status quo reemerges, and it's back to normal to some degree.
Right.
We think that that is also going to happen this time around, at least in the short term. But over the longer term, because of this continual underlying pressure that's there on the geopolitical front, it will require a greater degree of energy and commodity spend, and that's going to keep a very slow burn, continued demand for those kind of things over time. And we think that's where the opportunity lies, focused on the longer term need for all of these things to be built out. So I can share
Right.
my slide if that would help.
Absolutely.
It's our key slide where we showcase our sub themes. And let me just share that. So let me know if you can see it.
You bet. It's rolling.
Okay, fantastic. So this we've shown this before, Stu, and it basically is talking about our big picture super cycle theme that we think is a commodity oriented story, which started in 2021, and we think it still is in its early stages and will be a multi-year cycle, just like the prior ones that we've seen in the past, such as the one that we saw in the 2000s or the one that we saw in the 1970s. And this one we think is going to be similar in length, although it'll have a mixture of different things from the 70s and the 2000s contributing to the growth and rise of it. And as you can see, we have these four sub themes. And what's recently been playing out is these two on the left, which is the escalation in geopolitical risks, and gold continues to have a bid on it.
Right.
It's still this area that is seen as being seen as a safe haven. And as the bombs have been falling and there's been the conflict escalating over the past couple of weeks, gold has held steady while some of the other markets might have been wobbly here and there, but gold has been holding steady. It hasn't
Right.
had a full breakout yet in terms of its price, but it is touching or nearing all-time highs already. And we think that there's more and more room for that. And we can talk about that as well. And then on the left is energy. And, the big news over the past week or so has been the spike in oil prices and energy prices as a result of concerns around strained supplies. If you get into a situation where a refinery gets blown up or a oil
Right.
patch gets blown up or just shipping gets constrained, all of that is feeding into that fear. And that's why you've seen oil from pretty low levels where the market earlier in the spring or in the summer was concerned about and pricing in an economic slowdown where demand might not be as robust. And at the
Right.
same time, oversupply in the market coming from the US producers continuing to produce, but also OPEC beginning to increase their production, or at least committing to increasing their production to where it had earlier said it would do so. And so all that increase in supply and the lackluster demand was weighing on the market. And then the surprise came with this geopolitical spike, and you've seen oil prices rise surprisingly to the upside and catching many, many investors who probably were short oil because of those more consensus type of views. And so you've
Right.
seen this spate, in our view, this spate of oil covering, oil buying, and just rising oil prices as a result of that. And our strategy, we invest in all those things, including gold and oil and gas and uranium. And so all of those pieces of the puzzle have benefited that type of a strategy, if you will.
We as we're recording this this Monday morning, Brent is at 74.61 as we are recording. And the Strait of Hormuz, if it got shut down, it's roughly 90% of the Iranians' budget, 90 to 95%. And so
Yep.
it would absolutely cripple that. If there is going to be a regime change, you would want them to have a resource of money coming in to fuel a new government. So I'm hoping it is not disrupted. I'm hoping for the Iranian people themselves that it is not taken out. But the LNG is not often talking about, as it have coming from Qatar and coming from the
Mm-hmm.
UAE and everything else. I believe it's 20% of the global LNG market which is shipping to Europe and everywhere else. That's a huge chunk that would be taken off the market. I don't know that they would do that, because if Iran did that, it would be like a wolf in the corner. It bites everything it can on the way out, and being, mauled, it will do. You don't know what a wolf is going to do, but he's probably going to bite. So don't stick your hand in there. But in this case, I'm hoping they don't shut it down. They haven't in the last 15 times that they have threatened to shut down the strait. But China and Russia are two that I'm not sure how are going to handle this situation. Russia seems to be staying its course and focused on its own geopolitical problems with Ukraine. And China, they're the wild card here. I'm not sure how they're going to. Three huge military transports landed a few days ago in Tehran. Were they picking up or dropping off? I don't know.
Sure. Yeah. Well, I mean, there's a few things to consider, Stu, as you mentioned. In the Strait of Hormuz, it's when we hear about it in the news and the headlines, we think automatically, oh, Iran and Iranian supplies. But guess what's on the other side of the water? It's Saudi Arabia, it's Bahrain, and it's Qatar. And all of those countries also push oil out through that water body. And as you mentioned, the LNG from Qatar, which is a huge part of their economy and their growth.
Right.
So all in all, when you factor that in, you're talking about 21 million barrels of oil or oil equivalent per day coming out of that tiny little piece of water, right? And that amounts to about 20% of the world's need, because the world consumes about 100, 105, 102, somewhere in that neighborhood of oil barrels a day. And if you take out 20% of the supply, that's going to be a big impact to the price of
Huge.
oil. Because what's interesting is the price of oil is actually determined by the incremental change. So it's really the supply increase and decrease at the margin. So even if you reduce the supply in the world of 500,000 barrels a day, that can have an impact on the price, because a lot of the usage is determined by the incremental supply that's coming in. So all of that is to say, a 20% reduction in the supply would be enormous to the price of oil, and by substitution to the price of natural gas. And so the entire energy complex would have this massive, massive move up. And to your point, that is mutually self-destructive for all parties involved.
Right.
The Western world, the US, Europe, we cannot afford a significant jump in the price of our energy, and neither can Iran afford that kind of a drop in their income. That would assuredly, shoot themselves in the foot. And then lastly, you mentioned China. China also, is one of the biggest buyers from Iran, Iranian oil. And so that impacts them. And, being a net importer of oil and natural gas, they like low prices. They want low prices. So it just serves the world better if we keep that open. And that's why up until now, for many, many years, no matter how many times this escalates, and we have to take a step back and remind ourselves that this generally occurs every 5 to 10 years. This recurs. And whenever this recurs, you have this escalation, you have this build out. And as a result, you have these fears, and then eventually they subside and things not necessarily go back to normal, but at least it becomes at least somewhat subdued and spread out in terms of the risks. And so we think that is likely in the immediate or short term. Overall, in the long term, it still requires the world to continue to build out their capabilities because of the need to have competing areas of influence between the US and Europe now building out their own military and defense capabilities. So all that's going to need commodities over time and energy over time. We just think that immediate spikes like this usually fade, but that'll be undergirded by a gradual rise in the need for these types of commodities, especially energy, over the course of history. There's one chart that I've always shown you, Stu, which is the world continues to consume more and more energy over time, no matter what happens. I can share that. It's
Please.
It's a really eye-opening chart whenever people see it, because when we think about these type of things and we hear about them in the news and we don't see the data, we assume that energy and energy usage is declining because we're becoming more efficient, because we're becoming more abundant. But the reality is, since 1965, as this chart is showing, the usage of energy, the consumption of energy around the world has done nothing but go up. There have been shorter term periods where it's either flattened out or declined. So these two blips that you see towards the the right side. The
Right.
first one is the Great Financial Crisis, and then the second one is the pandemic. Other than those two periods, it's been pretty gradually continuing to rise. And so we think that that's going to continue to happen. And why is that? Even though we have the ability to produce more energy, what ends up happening is because of human innovation, human ingenuity, cheaper and more abundant energy actually equals usage of either the same amount or even more because we
Right.
find new technologies and new ways to harness it. Case in point, the latest, greatest high energy usage around the world is AI. So with AI, we're going to be building a lot of data centers. Those are already in existence. They already are consuming a lot of energy, and future ones are being planned and going to be built out. The US has the most number of data centers around the world. We can be assured that other countries around the world are going to be building similar capabilities. And so all that energy is going to be needed. And whether that's translating to natural gas or nuclear, those are going to continue to rise and be needed. So in our view, the gradual need for energy will be there, and it will be persistent, and it won't be abated or go away with any type of innovation, barring an economic crisis. And even economic crises in the past have shown that that reduction in the demand is always temporary.
Right. Well, I'll tell you, I just got from Michael Yon is a war correspondent who has been on the podcast before, and he just sent me a note. The Al Udeid Air Base in Qatar was attacked by Iran. We're again recording this on Monday
Yep.
afternoon, and it's like, holy smokes, Batman. Even as we are sitting here recording this now, I knew yesterday that the United States had removed all of its airplanes out of that air base, so nothing was there. It might have been a symbolic attack, but we are in a really telling time here.
Sure. Yeah, it is. The headlines crossed, and I saw it, and then immediately looked at the market, and you saw a dip. You saw a dip in the S&P 500,
Yep.
and believe it or not, it rebounded and it's back up to positive. In fact, it's hitting its highs of the day right now. And
So
again,
your
we're
comment
recording this.
earlier is like, so people have already baked in a certain margin for give or take of geopolitical things going on. Do you remember before, like 2 weeks ago or a week ago, we had three tankers on fire in the Strait of Hormuz,
Yeah.
and they were on because two of them had hit because of the spoofing and the GPS detection
Yep.
systems and everything else. They weren't attacked. I can remember a time not that long ago that a tanker on fire and you would see a $20 hit increase in oil. Not anymore. They're like, oh, well, I got to get a cup of coffee or a cup of tea, and there's three tankers burning. This is
Yeah.
nuts.
Well, I think when you look at the financial markets, as I said earlier, the underlying consensus and viewpoint is that we have abundant supply.
Right.
And so there's all that. So as I said earlier, barring the Strait of Hormuz, which would be a big disruption in the percentage of supply, these
Right.
kind of these other things are generally seen as passing and fading and short-lived. And so that's why a lot of financial markets tend to fade those. The other thing is, as you mentioned, the Iranians wanted to show something that they're doing something as a retaliation.
Right.
They talked about it, so they need to show that to their people. And in this day and age, as we were talking about earlier, Stu, is this conflict, at least for now, seems
Yep.
to be where it's somewhat orchestrated, a little bit of a dance. We're going to do this; it'll be proportionate. We're going to do this because I think everybody is aware of
Right.
the risks of continued real escalation of the situation, and that it seems to
Right.
be cooling heads are still prevailing, and they're trying to avoid that. And what I it seems like to me right now, what Iran is doing with this strike is internally they're probably going to be showcasing it as a big success, so that they can say they did
Yep.
something. Whereas it's probably an attack in a base where the number of troops are already out, or the damage might be minimal, and it might be a little bit more of a show. So, but it
Right.
all depends on how this tit for tat continues and where it goes. And so
But
that'll be interesting to see how that
it,
evolves.
80 or 89%, somewhere around in there, of the oil that Iran produces goes through their Karg Island export facility. They have their other newer facility closer to the Strait of Hormuz entry point there. But I noticed that there's a report that just came out that Israel shut down their Leviathan field natural gas
Yeah.
plants, which is affecting Egypt's, and at the second order of magnitude of impact is the fertilizer stock in Egypt. So these wars for commodities and natural gas and fertilizer and everything else is a domino effect that it is impacting Egypt's ability to produce fertilizer. It's like,
Yeah, and that's sort of the nature of a heightened geopolitical era. And even though this one incident, this particular conflict might be another line item in long list of conflicts that have faded over time,
right,
what we are witnessing is an era that we think we crossed the Rubicon in the pandemic, and as a result of a lot of forces that have been building up over many, many, many years,
right,
it's been a confluence of different forces coming together where we do believe that we are in this higher level of geopolitical and sort of conflict era, which will have these knock-on effects. So if you recall in 2022, when Russia invaded the Ukraine, Ukraine is a breadbasket of the world, not of the world per se, but they're a big, big wheat producer and a breadbasket for a lot of European needs and Middle Eastern and Asian needs. And you saw the price of wheat go up, you saw the price of grains go up, and you saw the price of fertilizers go up. So that does have these knock-on effects, and it's probably again a case of a temporary move that'll fade as supplies resume and things come back and renormalize. So you're going to see that, but in the meantime, this is something that's going to continue to have disruptive impacts. And the longer these things persist, there are intricately connected systems that we are relying on. And if anything in the system gets disrupted, you could see these knock-on effects carry out over into areas that we wouldn't even have imagined.
now, we have not talked about this before the recording of this podcast, and I may put you on the spot a little bit here, but how is Maria Partners doing with your fund, and how are things going? Are you proving that your theory is profitable?
So we launched our strategy in the shape of an ETF earlier this year. So it's the Surmaya thematic ETF, and the ticker is Lens, LENS.
Okay.
You can pull it up and look at it, and it's been doing really well since the launch. So since we launched it, which was in January of this year, it is up double digits in percentage terms, whereas the broader market, whether you look at the S&P 500 or the Nasdaq, despite the rally we've seen over the past month or month and a half since the April lows, we are still doing a lot better than them because of what we're investing in. And I would say the larger contributor to the strategy this year, at least, and for the past few years, has been our gold and gold mining stock positions that have been helping us. So
Nice.
it's been a great um, period for this type of strategy, and we've done really well. And it's heartening to see sort of the results show
Yeah,
up.
and I didn't mean to put you on the spot, but I respect your opinion enough on these types of global financial issues that I was hoping it was a good answer instead of saying, "Why no, Stu? We're lower than the S&P." I'm like,
No,
"Holy, whoops."
we're doing really well. Thank you. Yeah, thanks for asking.
Okay, good. I feel better about being able to ask that. But when as we sit here, what kind of things are you looking for during the second half of this year? Because if we sit back and take a look at oil, I think we're going to level out. $75 oil is probably going to stick around for a little bit. I could even go back to the 60s again
Yeah,
based
yeah,
on that. But I think that in the overall view, there's still trillions of dollars needed in order to meet normal decline curves. So I'm still
exactly.
bull, even without geopolitical issues. I'm still a perma bull. I think there is going to be a point And Josh Young over at Bison Interest
Mhm.
has said the longer that it kind of floats along here in the 60s, the higher it's going to go and rubber band back up. I like Josh. Josh is a cool cat, very much like you. I apologize if I called you a cool cat, but
No, it's
he
okay.
is very much like you that I trust his opinion on those things.
Yeah, we would definitely agree. I agree with your viewpoint, and that's why we have the energy sub theme in our portfolio.
Nice.
What's happened is, and what is happening is, as I mentioned earlier, the markets, the financial markets generally are focused on the here and now, and the consensus
Right.
is focused on what's going to happen in the near term. And the near term concerns are an economic slowdown coupled with an oversupply environment from Saudi Arabia and OPEC plus. And so
Didn't
that's
Pat hit
that
it?
that had been weighing on the price of oil, where you saw that decline in April,
Right.
and there was talk of $40 a barrel oil, $50
Right.
a barrel oil, and we never got there. We barely broke 60, and then the geopolitical stuff spiked again. And as I said earlier, the geopolitical stuff for price of oil in the short term is generally something that you should fade, because it sort of
Yep.
moves back to the fundamentals. Well, when you look at the fundamentals, I couldn't agree more with the idea that just like in any commodity, you need to continue to reinvest in the production capabilities, the
Right.
ability to produce more, because the demand is just gradually continuing to rise. And all of the big institutions that have projected demand for oil over the past several years have pretty much been undershooting their estimates, and demand has generally been higher than what they've been estimating. And we think that that likely continues. And with this underinvestment that's taking place, it's laying the ground for higher and higher oil prices in the future. So we would agree with that viewpoint, and that's why we have that allocation. And this
Nice.
stuff right now, this volatility, this near term stuff, is just to us is short term noise on the way to higher oil prices because of a longer term fundamental demand story. Now, to answer your question on the second half of the year,
Right.
what might work, what might pan out is sometime in the second half of the summer, call it July or August, maybe into September, we might start seeing a bit of a softening or a slowdown in the economy, and that might spook the markets.
Right.
And at that point, if the Fed feels that there's enough market volatility and if there's enough pain, they might then come in and step in and reduce rates. And whenever the Fed has cut rates in the past, and we're not saying that that's going to happen anytime soon, the Fed might need to be pushed into it or pressured into it by market forces or a real recessionary scare. Barring that, they might hold the course for now, especially with oil prices spiking again, because that feeds into inflation.
Right.
But if they do get that pressure, they could cut rates, or they could indicate that they're going to cut rates. And that would mean that would put downward pressure on the dollar. And the dollar going down is generally correlated with commodities going up, because commodities are priced
Hmm.
in dollars. And so there's generally an inverse relationship with the price of commodities and the price of the dollar. So we think that we are in an era where you're going to see a softening and a declining US dollar. Just like we saw in
I
the
agree.
2000s, we are in
Right.
no way calling for a de-dollarization. We are in no way in saying that, there's going to be that kind of a substitution. But
Right.
you go back 50 years, and there have been periods where the dollar has been down for multiple years by
Right.
30%, 40%, 50%. And that's simply capital flows. That's simply interest rate differentials, market cycles, economic cycles. And we think after a long period of a rising and a strong dollar, we are probably now in an era where you're going to see a weak to declining dollar, not a crash, not a collapse, but just a
Right.
gradual weak to declining dollar, which would bode well for commodities and
Right.
commodity related equities like emerging markets, for example.
Let me ask this. There's about 16 questions that just came up as we are going through this. The Japanese bond market is in a serious turmoil, and going on with Japan owning so much of the U.S. debt. And then you take a look at the horrific problems that is going on in the bond market. It's cool that we're seeing such great investment from Japan trying to recover into the US. Maybe that is a way for them to try to solidify that. And we're seeing other great investment from other countries into the United States energy market. Do you feel that that's a way that countries are trying to stabilize their own energy security and their own bond markets?
Yeah, I think that could be the case for sure on the energy side to show the investment. The natural gas here is so abundant and so cheap. That's a
Right,
great place to get some of the investment and the capabilities for sure. I think one of the challenges is that when you look at Japan, for example, they are now seeing inflation at levels they haven't seen in decades.
right.
And so it's great because they've been wanting to spur inflation for the longest time because they've been trying to fight deflation for 30 years. And so, in
Right,
absolute terms, the inflation isn't alarming, but in relative terms to where they were simply 5 years ago,
yep.
which was zero to negative inflation, to where they are now, it's been a big jump. And it's now feeding into food prices, rice prices, which is a big staple. And the BOJ has been very, very slow to raise rates because, number one, they don't want a repeat of what they've done in the past. In 1997, they raised rates and sent the economy back into recession and causing more deflation. So they want to see this continue on for some time before they get comfortable. So that's number one. Number two, I'm sure we've all heard of the yen carry trade that had a little bit of a hiccup last summer, and everybody became an overnight expert in the yen carry trade at that time. But that is alive and well. And one of the things that could happen is as bond yields rise in Japan in
Right.
response to inflation, the government is now committed to, the BOJ said, and the government is saying that they're going to issue more short-term bills instead of longer-term bonds because effectively
Nice.
the BOJ owns the majority of that bond market, and there's not much activity there. So all of that is to say, Japanese inflation may force the BOJ to raise rates, which would then require or reawaken Japanese money that's invested overseas to want to come back to Japan because now you
Uh,
can actually earn a yield because now you can actually earn a return. And if that is in the face of a declining dollar and a rising yen, then in yen terms, those returns are even less as the dollar is declining. So there's a risk that the Japanese actually at some point may begin to pull their capital outside of the US. So one of the things that we think about is in the US broad equity market, it is very heavily owned. When you think of the Mag 7, you think of the big technology sector, the
right.
big exposures. The US equity market and those big mega cap names are not only owned by US investors. There's
Right.
a large portion of those stocks that is actually owned by non-US investors in
Right.
Europe, in Asia, both individually, but more so with sovereign funds, with insurance companies, with all sorts of asset management companies that have the exposure. Why? Because it's been the best performing market for well over a decade, and
Right.
its returns have been spectacular, and they've been invested here. Well, if those returns come under pressure, if the dollar comes under pressure, and in local terms the returns aren't there as much, then you
Right.
could see a flow of capital from the US back to those countries and their markets as they see better returns in those markets. For example,
Wow.
European markets are actually up so far this year.
Yep.
Believe it or not, Germany is up over 20% so far this year, their stock market. Why?
I did
Because
not see that on my bingo card.
bec- and 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 the reason is because there's this resurgence, if you will, this renaissance of the build out that they're promising or trying to do on their industrial and defense capabilities, and they're going to be doing fiscal deficit spending in order to do that. They have the bandwidth to do it because they've been running pretty tight deficits, and so they
But
have the
they've had
bandwidth to
two
do that.
years of negative GDP growth over the last 2 years, and you're saying they're on track to increase their GDP this year?
No, no, no. I'm not talking about GDP. I'm talking about
Oh,
deficit spending.
deficit's been
So
okay. Got it.
so
I
deficits
missed it.
when governments borrow and spend more than they take in, that's
Right.
deficit
Yes.
spending. We've been doing that for a few years now, several years now. And
Right.
and when you take a step back and you look at the big macroeconomic picture, basically what that means is that the public sector, or let's say the government sector, is borrowing government sector borrowing actually translates into the private sector benefiting. And
Oh,
so the one of the theories out there is that our economy and our market has benefited from the deficits that we've generated. And if the Germans are going to do that now, then their economy could actually get a boost out of it because spending is spending, and that can increase economic activity and grow that side. So all of that is to say, Stu, that we might have entered an era where the capital that is sitting in the US markets may
right.
begin to migrate back to their home countries. And
Wow.
and that is a very, very slow moving phenomenon because this is trillions of dollars across hundreds, if not millions of accounts. And it just takes very, very long for people to gradually
Right.
get into it, make the decision, and the mechanics of doing the actual trade and moving it. So this could be a multi-year cycle of that capital gradually leaving the US and going back to their home country and investing in those markets.
But that's a trend for me to kind of start watching and stuff because when you sit back and take a look at the negative GDP growth out of the EU, they've had some serious problems, and that is different
Oh
than
yeah.
as you were mentioning the deficit spending, which is a totally different topic, and I was kind of misconstruing there on that. But as something that we would do, I absolutely treasure our conversation. And thank you, Wasif, for your leadership. Believe me, I will have you back again very quickly. How do people find you?
Well, first of all, thank you for having me. I love having these conversations with you. They're really good and I enjoy them. We are Surmaya partners, and the best way to get in touch with me is through our website. It's surmayapartners.com. Our ETF that I mentioned is at surmayaetf.com. And I'm also on Substack, where they can find me under my name, Wasif Latif, and the handle is Surmaya Car.
All right. Well, thank you so much for stopping by the podcast. We are in a different time, and I guarantee you, I need people like you that I can call up and say, what the hey is this all about? And so, with that, I again thank you all for listening today, and just reach out to Wasif if you have any questions about what's going on in the market. He is a trusted resource. So, thank you, and have a fantastic day.
Thank you, Stu.